right, so into today's masterclass, I'm going to start sharing my content. So quick introduction to myself. So my name's Andy Drummond. I'm the Chief Financial Officer and Chief Operating Officer of a channel technology company. Company I work for is Zift Solutions. We have a platform, a channel management platform, which is called Zift One. Hopefully some of you watching this know about us. Hopefully some of our customers are here and listening. But this session isn't about Zift One and our platform. So I think, interestingly, I don't put myself at all as an expert in channel. But I know channel, and I'm involved in creating metrics and dashboards for our Zift One channel management tech platform. And we as a business have a channel program of our own. So I think I'm in a really interesting place in being able to give a view on what the purpose of this session is really in general, which is, what does a CFO or decision maker outside of the channel really care about when making decisions about the channel? I think metrics for the channel are a minefield sometimes, kind of in themselves, and applying them in the right way is even more of a minefield. So this session, rather than lots of detail about the metrics themselves, is going to be more about applying those metrics. It's going to be focusing on the application of those metrics in your business setting to get the most out of your channel and to get the biggest appreciation out of the wider business of what you're doing in the channel. So there's going to be 3 sections of this session today, and I very much want to create them as 3 clear, distinct sessions. So the first one is going to be thinking about return on investment as a concept. The second is other channel metrics. We'll go through some channel metrics that you may use. There may be others that you use that are not on there. But again, the focus is really going to be about the application of those and how should you think about them as you present them to others. And then thirdly, SaaS metrics and the impact that your channel can have on those. The majority of my time is going to be spent on SaaS metrics here. So typically, I think we're all or mostly going to be from SaaS companies. And I think this is where you can really differentiate yourselves in terms of the impacts that your channel can have on your company's SaaS metrics. All right, so I'm going to start with return on investment. So ROI in general is probably the most important concept or metric behind business decisions in general, investment decisions in general. I think the problem with it is it isn't really a metric. As I just said, it's a concept, and it means different things to different people and different businesses, depending on what's the priority for that person or that business. It's really important to understand ROI in the context of your business and build business cases in that way. So to think about that more deeply, the overall ROI story that you might be building, again, depends on what's important to your company. So if we think about what different priorities could be in a typical business, could be cash return, immediate cash return, could be revenue growth as quickly as possible, could be longer term profitability. The stage of growth or capital structure of your company could drive what's a priority here. And you should think about that in terms of capital structure, type of company that you are. So to give some examples of that, so what could drive a priority being in one of these 3 buckets? So firstly, for cash return, let's say that your company is a VC, venture capital backed business, you're on a cash runway, and trying to do as much as possible within that runway and grow as quickly as possible. Your business might be thinking about what level of cash spend is required now, and when do we expect to break in even on that investment and then see a return? And is that within the cash profile window that we have? Do we see a return quick enough based on our current cash burn window? So an example of where revenue growth could be a priority. So let's say your company is well capitalized, key value driver in the company is revenue growth. You'll be thinking about how quickly does this investment turn to revenue growth? Is it a slow burner? Is it a fast burner? And if we were to spend this money some other way, for example, by, in this case, expanding direct sales rather than channel, for example, how quickly would we see that revenue growth? Would we see it more quickly or less quickly? And long-term profitability. So let's say working for a very mature company, the company has ability to invest over a long period. Long-term profitability is likely to be key for a business like that. You may well treat what you're doing as a business or division in its own right, building its own financials, income statement, and showing the potential long-term returns there. The analysis you would do on return on investment is very different depending on what the priority is here. So rather than talk about methods of how to calculate return on investment, my main takeaway here is understand where your business is and what's important to, or what's most important to the CFO and decision makers at the company, and build your business cases and return on investment calculations around that. Ask the question to those decision makers, what would be compelling to you to justify this investment? Rather than looking at Googling what should a return on investment analysis look like, ask that question first. Make sure you're really driving at what the priority in your company is. Okay, moving into the second section of this webinar, channel metrics. So there's a host of metrics that are particularly relevant to channel, and they can really help to illustrate ROI potential, but by themselves, I think they don't always create a compelling argument for a CFO or a decision maker. And they need to be set in the context of other things to be really compelling. So I want to help you understand and think about how you can use these channel metrics to your advantage. So firstly, I'm going to talk through some examples of metrics that are often seen as key metrics for the channel. Again, I'm not going to go deep into calculations here. I'm going to focus on why the decision makers outside of your channel might really care about these metrics. And if the metrics that you calculate for your channel are not listed here, you'll probably be able to apply the same principles to those metrics as well. So to start with sales reach. So this metric is really to show that your channel, the market that your channel can reach, that you otherwise as a business, as you stand today, wouldn't be able to get to without your channel. So these could be different geographies, different verticals, different applications of your product, anything that gives a better reach into a market that you're not in today, and measuring that reach. It's often thought about alongside channel capacity. So channel capacity is to show what revenue potential you've created for your business by having a channel. So based on what we've put in place today, if we were firing on all cylinders, what potential market do we reach by operating this channel? So when a CFO or decision maker thinks about these two metrics, they're really thinking about, what does this do to my total addressable market? and ultimately my revenue growth potential, and potential is the key word as a business. Total addressable market's really important for SaaS businesses. So often SaaS businesses are very high growth rates, and with very high growth rates, you can reach a point where you really need to expand your total addressable market to continue growing at the same rate that you were yesterday. So if you can focus on evidencing a significant expansion of your total addressable market and transformative revenue growth potential with these metrics, that's absolutely what you should do. These metrics show potential with the channel that you have today or the channel that you're thinking about putting in place. Partner engagement. So this is to show how active is your channel and is your partner community. When a CFO or decision maker thinks about this metric, they're thinking about how well are we capitalizing on the reach and channel capacity that we have. So we just talked about reach and capacity. Partner engagement is what are we doing with that, and how well are we capitalizing on it? My recommendation here would be, if you can, try to link any investments that you make or things that you do within your channel to improvements in partner engagement and evidencing the penetration that you're making into the potential that you've created with your channel capacity. Next one, incentives and MDF effectiveness. So this is a relatively straightforward one in concept. It's to show what you're getting back in return for your investment into incentives or MDF, put simply. When decision makers think about this one, they're thinking, are my investments generating the return that I want? Or would I have been better placed, or will I be better placed in the future in putting this investment to work elsewhere? Again, it's the linkage that's the important point here. Try to link any investment that you're making here to revenue that you've generated as a direct result of it. Partner NPS, Partner Net Promoter Score. So this is to show how likely your partner base is to recommend you to other partners. This is actually a bit of a softer metric, but I think about it a little like I think about employee NPS in a direct selling world. So employee NPS, even in SaaS companies where you're a software business, it is really often a leading indicator of customer NPS, which in itself is a leading indicator of customer retention. And I think in this case, when you're thinking about your channel, partner NPS is in turn a leading indicator of your customer NPS, the customers that are being brought to you through your channel, and in turn, again, a leading indicator of retention of those customers. Again, I think it's a softer link here, but decision makers in SaaS care so deeply about retention, and we'll see that later in the SaaS metrics part of this presentation, that actually a real focus here is important if you have any sense that this is driving your customer NPS and potentially retention. So then lastly, on channel metrics, segmentation analytics. I think these tend to be more relevant in a maturing channel, but if you can segment your channel in lots of different ways, and it's going to be different depending on the business that you are and the channel you have. It could be geography or vertical again, or type of product, anything. It can really help you to see what's being successful in specific segments of your channel and what you should go and replicate in other segments to replicate that strong performance across different segments of your channel. So work out what's doing the best and then replicate that in other parts of your channel. So bringing this all together, there are a few things I think that are really compelling here for a decision maker. So two main things. First thing is potential impact. So metrics like sales reach, channel capacity, they create real excitement for a decision maker about where this could lead in terms of growth potential for the business. And the second thing is risk, and actually links us back to our first section on return on investment. So a lot of channel plays are actually, or can be in the first instance, lower risk than direct plays, because often the initial investment need is lower. So to demonstrate the risk level, take whatever you think to be the right ROI analysis, that you understand to be important for your company, as we talked about earlier, and create scenarios with it. So if we invest X, here are a range of outcomes we might expect based on our potential sales reach and channel capacity. So there'll be outcomes that range from what's our best result to what's our worst result. And it's likely that with the way you structure your channel, the worst result could be pretty low risk for your company, and the best result could be like very high potential as being sort of transformative growth for your company. And if you can demonstrate that high potential impact and low risk together, then you're onto an absolute winner. And I can say that from experience with your CFOs or decision makers in the business, as to proving out the success of your channel through these metrics and why you should continue to invest or start to invest. Okay, so that's channel metrics. I'm going to move on to the kind of largest part of this presentation today, which is SaaS metrics, and SaaS metrics for the channel. And I'm going to cover what they are and why they're important. And I'm going to help you to understand a selection of major SaaS metrics and how to apply them to your channel. So typically SaaS metrics are not specifically thought of in relation to channel. I want to help you think about how you can make them relate to your channel. So a quick overview of the metrics that we're going to cover here. We've got recurring revenue growth, so either monthly recurring revenue that gets referred to as MRR normally, or annual recurring revenue that gets referred to as ARR. Customer acquisition cost, often referred to as CAC. Then you've got CAC, or customer acquisition cost payback period. Churn and net retention, the one I mentioned earlier as being deeply important to decision makers in SaaS. Customer lifetime value often gets referred to as LTV, and then the lifetime value to customer acquisition cost ratio and what that tells you. Before we get into these, I really want to talk about why they're important for SaaS businesses in general. So in general, the SaaS business model is different to any other. And typical financial metrics, so things like income statements and cash flow forecasts, those sorts of things can completely miss the mark in terms of analyzing the underlying health of your SaaS business. And here's the main reasons why, kind of illustrated on this chart. The detail on this chart actually isn't important. It's the concept that I'd like to get across to people. But this shows monthly cash flows over a 2-year period. So you've got bars that show cash in, cash out over that 2-year period. And then you've got a line which shows cumulative cash flow over that 2-year time period. So to think about the start of this in a typical relationship with a SaaS customer, so before you bring a new SaaS customer through the door, you've got upfront investment in things like R&D and building out your products, and close to the point that you bring your SaaS customer through the door, sales and marketing expense to go and find them and sell to them. So you see within the first few months of this profile that you experience cash outflows as a result of that upfront investment. So then you bring a new customer in, and you may have some more cash outflows. So depending on what type of SaaS company you are, you may have installation costs, and you'll almost certainly have hosting costs to maintain the platform. And then your customer starts paying you subscription fees, and you collect cash, and you see the cash inflows coming in sort of through the life of that customer relationship. Over time, you make back that initial investment from your customer, and hopefully become nice and profitable with that customer, over a longer term time frame. And on a cumulative basis, you can see that here as you get to cash flow positivity into this particular example after 17 or 18 months. So just imagine for a moment if you had the potential for explosive growth in your SaaS company, and you had the option or potential to do this 10 times or 100 times over. So rather than bring this one customer in with this cash flow profile in, bring 10 or 100 in. What happens is that this profile just layers on top of itself. So you get more cash flow. The more customers you bring in at the front end, the more cash flow negative you become in the front end. But conversely, the more cash flow profitable you become at the back end. If you were to look at this business with kind of traditional finance metrics in year one, it would look probably really horrible. But what you've paid for is the potential for future profitability. And SaaS metrics are there to analyze that piece for us and really analyze the underlying health of your SaaS business, where typical metrics would miss the mark. So first metric that we had listed to talk through, recurring revenue growth. So recurring revenues, as I said earlier, often referred to as MRR, which is monthly recurring revenue, or ARR, which is annual recurring revenue. It's the simplest metric, but it's often the most important thing in SaaS, actually. If you don't know what it is, you can think about it pretty simply as the total subscription fees that your SaaS customers are paying you on a monthly or annual basis. For me, I think really the only takeaway here is I suggest that you understand the metric that your company typically uses. So does your company talk about MRR or ARR or some other method of measuring recurring revenue? But whatever it is, just make sure you understand the measure and talk in the same language and feed it into any pieces of analysis that you might be doing on things like return on investment that we talked about earlier. Really, the other SaaS metrics that we're going to talk about now feed into the overall result here. So what you're doing in the other metrics is ultimately to drive recurring revenue growth as efficiently as possible here. So next metric, customer acquisition cost, or CAC. So this is all go-to-market costs that are focused on new customer acquisition. So typically this would be your sales and marketing costs. So this is pretty easy to calculate and split between channel sales and direct sales. And I think interestingly, it's likely to be lower for channel than direct, at least in the first instance. This metric's actually a little meaningless by itself because you don't know what you've made back in return for this investment. This is just the cost piece. What we're going to do as we go through these is build up a worked example to help understand how all the SaaS metrics link together. So we're going to start here. So let's say that last month, we as a company spent $120,000 on customer acquisition costs. So then payback period for those customer acquisition costs. So this is how long does it take you? How many months does it take you, your company, to earn back the customer acquisition cost that you spent, the investment that you made to bring in recurring revenue from new customers. So to continue our worked example here, let's say that last month's marketing and sales spend brought in one new customer, and that new customer had $12,000 of MRR, monthly recurring revenue. So they're paying us $12,000 on a subscription basis each month. We'll have some costs to service this new monthly recurring revenue. So hosting costs, for example, what we spend on maintaining the cloud hosting costs of our platform. So let's say, for simplicity, that we spend $2,000 a month on that. So once we've paid that each month, we've got $10,000 left of that revenue. So that's our gross margin. So then, remembering back to the previous slide, we spent $120,000 last month on sales and marketing. So with our $10,000 a month that we're earning in gross margin, we'll pay that back once we've earned 12 months of this new customer subscription revenue. So they pay us $10,000 for 12 months. That'll be $120,000 in the door, and that's paid back our last month's sales and marketing investment. I think this metric's actually really interesting for the channel. So typically, as I said earlier, there's likely to be less upfront cost in customer acquisition costs with the channel, which, to our earlier point, means less risk in terms of building out a channel play, which could make this metric look really attractive in your channel compared with your direct business. The flip side to that is there can be more cost later in a channel relationship, third-party commission, for example, but the risk kind of taken away at that point. So potentially evidencing a better CAC payback period in your channel, or a lower risk CAC payback period in your channel, could be really compelling for somebody who's making a decision in terms of how to allocate investment. So next metric, churn and net retention. So this is the percentage rate, or net retention is the percentage rate at which SaaS customers leave you or cancel their subscriptions. So that's normally referred to as churn. Reduce their subscriptions, which is often referred to as downsell, or increase their subscriptions, which is often referred to as upsell. Again, to continue our worked example, let's say that our business has got $12 million of annual recurring revenue, which is $1 million of monthly recurring revenue. If this month we lost 5% of that recurring revenue to churn, we lost 3% to downsell, and we had upsell of 5%, we'd have 97% left of that $1 million of MRR, or $970,000 at the end of the period. So we had 100% at the start of the period. We reduced that 5% through churn, so down to 95%. We reduced it a further 3% by downsell, so down to 92%. But then upsell took us up at 5%, back up to 97%. So 97% left, $970,000 left of that monthly recurring revenue that you started the period with. Under a different scenario, so let's say that we lost less to churn and downsell, so 3% to churn, 1% to downsell, and we did better on upsell, 7% on upsell. Same example, different metrics, we'd have 103% of that MRR left at the end of the period, or $1,030,000. So think about net retention as analyzing what's happening economically to your current customer base. So excluding any new customers, just thinking about what happens over a time period with your current customer base. And what do you have left at the end of that time period? Do you have more, so the 103% in this example, or do you have less, the 97% under this example? If you have 103% net retention, so I'll come back to that actually on the next slide. But before I do, I just want to say I really recommend that you think about tracking this segmentally for channel against direct to analyze the quality of customer that your channel is generating. So as SaaS businesses grow, retention of your book of business and being able to upsell your book of business actually becomes potentially more powerful for growth than what you're able to do in the new market. So the health of your customer base and how well you're able to retain them is really powerful, particularly as you scale as a business. And I think it's really important in the channel to understand the health of the customers that you're bringing into your business. Do you have better or worse retention rates with customers that are coming to you through the channel versus direct? And if you do, how does that make you think about the investments that you're making? So to go back to the example, and the metric in general, it's, as I said, it's of huge importance to SaaS businesses in general, and you'll find that decision makers really, and I do, analyze this deeply and try to understand it. And I want to show some analysis that is really just maths that explains why. So if we take our two examples from the previous page, so the 97% monthly net retention and the 103% monthly net retention, if you have a 97% monthly net retention and you're adding new customers at a consistent rate, your growth curve will look like what it does on the left. So basically your growth curve slows down over time. Conversely, if you've got 103% net retention and you're also adding new customers at a consistent rate, your growth curve would look like it does on the right-hand side. So speeding up. So basically what's happening here is if you're losing revenue from your current customer base, it's likely your growth curve slows down over time. But if you're consistently selling more to your current customer base and bringing new customers in at the same time, you can create a pretty much exponential growth curve here. So your current customer base, you're growing their revenue over time as you're able to sell more to them. You then bring new customers in, and then you're able to sell more to them over time. You create this really very attractive exponential growth curve, which the best SaaS companies have. And these evidence the more we grow, the faster we can grow. And that's a really powerful place to be as a SaaS business, and is the exact reason why you probably hear people at your company, or you at your company, care so deeply about what your net retention metric is. Under this particular example, at the end of 3 years, you'd have 3x more MRR with the 103% net retention on the right than the 97% net retention on the left. I think that's what looks like a relatively small difference between a few percentage points, 97% to 103%. I think that just really illustrates the power of 100% plus net retention in a SaaS business. And for those of you who are investors out there, effectively, this is applying compound interest principles to your SaaS business on the chart on the right-hand side when you're above 100% net retention. So next metric, customer lifetime value. So this is the value of gross margin your customer will bring you over the lifetime of their subscription with you. Getting back to our worked example, let's take that one new customer that we sold last month who has $10,000 gross margin per month that they're bringing you after you pay those hosting costs. If we expect to keep that customer for 5 years, which is 60 months, then over that time period, they'll bring in $600,000 of gross margin over the 5-year period. So $10,000, 60 months, that's $600,000 of effectively of income for your business. So this is known as the customer lifetime value. Similar to one of our earlier metrics, this is a metric that is kind of interesting by itself, but it's actually most interesting when it's compared to your customer acquisition cost. So the way we do that is a ratio between our lifetime value that we just looked at and our customer acquisition cost. So just describe it. This is the lifetime value divided by your CAC, and it's designed to show you the multiple of return you'll generate on each new SaaS customer that you acquire. So again, to continue our worked example, we know that the lifetime value of our new customer is $600,000. From earlier in the presentation, we know that we spent CAC of $120,000 to acquire this customer. And this gives us a lifetime value to CAC ratio of 5 times, 5x. So it costs us $120,000. We brought in $600,000 over the lifetime of the relationship. That was a 5x return on this particular SaaS customer. Now, if we're here and really above a number of 3 to 5 is seen, I think, as good in SaaS, get higher and like that's fantastic. If we're in this position, it's likely that the right thing for the business is to accelerate everything that you're doing and bring customers in more quickly, because they're making you a 5x return over their lifetime with you. And if you're better than this, like a much bigger return. So this metric is really the SaaS metrics version of return on investment. And I think it brings them all together really nicely. That's all of the metrics, all of the SaaS metrics. Rather than wrap up SaaS metrics, I actually wanted to wrap up everything together. And I've got 2 pieces of the wrap up here. So firstly, here are my major takeaways from each section of today's presentation. And secondly, I want to wrap up by bringing it all together as well. So right back to our first section, return on investment. Our major takeaway there is understand what's important to your CFO or decision makers, whoever they may be, and make sure that you're building your return on investment business cases around them. We didn't talk about what those return on investment business case like calculations should be today, because the most important thing is find out what's important and then work out what's the best return on investment analysis to do. Our takeaway from the channel metrics part of the session was understand why your company decided to pursue channel and use channel metrics to prove the theory, and use them to evidence the high potential and low risk of what you're doing in your channel today or what you're intending to do in the future. And then on SaaS metrics, if you're in SaaS, decision makers probably care most about SaaS metrics in terms of running the company. Make sure that you understand them, which this session was designed to do today, and calculate them segmentally for your channel. See how you stack up against the direct business, and that should really help you allocating investment across different parts of your business. Really, to bring this whole session together, I wanted to do a second wrap-up slide. In what I see as the ultimate business case for the channel operating in SaaS. So firstly, use your channel metrics to generate excitement about potential. Next thing to do is feed these into your return on investment analysis and use scenario planning to illustrate, I've said this a few times and I don't mind continuing to say it, illustrate high potential and low risk together. Then illustrate the positive impact that pursuing your recommended strategy will have on your company's SaaS metrics. Understand the SaaS metrics, illustrate the impact. And then as you take this forward, track those SaaS metrics segmentally for your channel to drive the right decision making and ultimately drive success in your channel. This is what I, as a CFO and a decision maker, in a business that's and where I personally am somewhat slightly removed from channel, this is what I see as the ultimate business case use of metrics for channels of companies that are operating in the SaaS world. If you took something like this to your CFO at your business, and it all added up and made complete sense, then you're onto an absolute winner. And that's what I'd like you to take away from today. So I've talked a lot. I think we have Q&A functionality built in here. So we'd like to open it up to questions for the last part of this session. Okay, no questions. So I guess we'll wrap up. Another reminder, virtual conference coming up on June 23rd. Make sure you're getting signed up for it. And thanks to CSA for having me on for this session today. Feel free to follow up with any questions you've got directly with me. We'd love to chat. Thanks all.